What up, fam? Little big event over the course of last week, and today we're going to expand on it. You're watching Sept, and today we're discussing the Bank of Korea's decision to increase their base interest rate up from 0.5% to 0.75%. Now, before we continue, we just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. For that reason, nothing we say here should be taken as basis for investment, and you'll have to do your own work and thinking before deciding whether or not to take up a position on any stock mentioned here. Want to know how? Well, if you scroll down a little bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And that being said, let's get to it. Alright, so after having covered the concept of QE and tapering in a recent video, we're going to continue talking about some other key duties that central banks and the Bank of Korea have. If you'd like to know what we said about tapering and QE, feel free to click in the top right hand corner of your screen right now, otherwise let's roll on. Now, as we mentioned in that video, the main role of central banks is to enact monetary policies which aim to stabilize prices. In recent months, we've seen central banks around the world use qualitative easing to increase the money supply during the financial crunch brought on by the pandemic, and we're likely to see tapering as they aim to reduce the potential for excessive inflation. Another tool that they have in their box is that of controlling the country's base interest rate. This rate effectively determines the ease at which banks can borrow money from the central bank, and during the pandemic, the Bank of Korea chose to combine stealth QE with a more widely announced lowering of interest rates. Now, this tactic itself isn't really a new thing. For years, the base interest rate trend has been dropping from 2% in 2014 to 0.5% over the course of the pandemic, and it was at 5% at some point around the turn of the new millennium. Now, while this allows for greater access to credit for the average consumer and business, it also comes with a more precarious economic situation as debt bubbles expand and debt crises arise. Now, rather than making a big explainer on the macroeconomic effects of interest rate hikes and adjustments, which I'd be happy to do if y'all let me know that that's something you want, I want to talk about the changes that have occurred within the Korean consumer credit market over the past couple of weeks, of which there have been some significant developments. Now, we've talked before about how low interest rates drive people to borrow at greater amounts, resulting in overheated markets at times. What we haven't really mentioned over the past few months has been just how big the household debt in Korea has become. Since the central bank slashed their interest rates to 0.5 last year, more people have been taking out larger loans, both chasing and speculating on increased asset prices. This has led to a record 1.765 quadrillion won in household debt at the end of March and 1.8 at the end of June this year. And this has been driven by a number of factors, including speculation in the stock markets, but the central bank has been pointing to the overheated housing market as the leading factor in the nation's household debt crisis. Now, with the increase in interest rates, the BOK aims to reduce excess liquidity in our system while also slowing the growth of the national household debt. As the result of policy changes by the financial authorities, we can actually feel some changes directly in the credit market based on what banks are doing right now. And let's get to the specifics right now. Now, since the declaration of the interest rate hike, we've seen banks immediately rushing to increase their interest rates on their loans. This makes sense. As it becomes more expensive for them to borrow money, it becomes more expensive for them to loan out money, and thus they hike the rates because it becomes more expensive for us to borrow that money if they still want to continue to make a profit. Now, for example, we have KB, Shinhan, Hana, and Uri Bank, who have all hiked their rates on variable interest loans. One issue that consumers have raised, however, is the fact that many of these banks have yet to adjust their savings interest rates, which are generally still sitting below the 1% mark. Thus, while banks have made it more expensive to borrow, they haven't really made it more beneficial to commit capital to them. Whether we'll see savings rates increase substantially in the near future has yet to be seen, but one would assume that we will. How closely they'll correlate to rising loan interest rates, we have yet to see. Now, another thing that banks have done in cooperation with financial authorities' requests for assistance in addressing the household debt issue has been to limit unsecured loans specifically to the borrower's yearly income. This is a replacement to the traditional loan system that uses credit scores and histories to determine loan limits. Institutions that have complied with these requests include banks like Uri, KB, Shinhan, and Hana, as well as online banks like KakaoBank and Kbank. According to Joongang Daily, we can expect to see these changes being made also by savings banks, insurers, and card companies in the coming months, as financial authorities have requested the same of them in case borrowers migrate over from standard major bank loans. Now, given the overall difficulty foreigners face with regards to receiving unsecured loans in the first place, I don't expect that this will apply to the majority of viewers of this channel, but it's certainly something to pay attention to as these changes begin to affect the spending habits and real-world economy around the country. Finally, I think the most interesting change that we've seen in recent weeks has been the decision by banks to bare halt the insurance of mortgage loans over the next few months. Starting this week, Yonhap Bank, which is one of the nation's 5 largest, will halt the issuance of new mortgage loans through the end of November. Uri Bank has made a similar move, restricting mortgages until the end of September. Whether this will be followed by other banks has yet to be seen. Now, while increasing interest rates may have positive macroeconomic effects with respects to slowing and reversing national household debt and hopefully cushioning what the BOK expects to be a large housing price adjustment, the brunt of the impact of these adjustments is most likely to be eaten by young people and SMEs who've seen their financial security dwindle since the start of the pandemic last year. In the present and immediate future, young couples and families who've taken out variable chonse loans can expect to see their rates increase, and this is a really tough beat given that the interest paid on these loans generally don't contribute to the borrower's financial futures, unlike the variable rate mortgage loans. At least with mortgage loans, you get to keep the house at the end. Now, whether or not these curbs will be strong enough to slow or even reverse the trend of housing market prices has yet to be seen, but with economists expecting an additional rate hike in the near future, we may be in store for a bit of a bump in the road in the short to mid-term. Should the central bank increase the rate too much too quickly, we could be in for an increase to mortgage delinquencies as well. Hopefully they don't. I'm sure they know what they're doing. Now, this is of course the bearish position that we've been discussing over the course of the video, and it's a good example of why markets tend to contract when base interest rates increase. Still, it seems as if the financial authorities are ready to rip off the band-aid in hopes of bringing balance to our country's current credit situation. Alright, that's it for me. I know I went over a lot really quickly, but for a better understanding of how credit markets work or what levers central banks can pull to deleverage an over-leveraged economy, I very strongly recommend watching Ray Dalio's explainer titled How the Economic Machine Works. In that video, he explains credit cycles in a way that's far clearer than I ever could. Anyways, I'll be back soon with another breakdown of what we're watching in the market right now, or maybe I'll talk about another big stock. Feel free to add any suggestions in the comment section below. I'll check them out, and if it's something that I think everybody can benefit from, then I'll talk about it. Or even if I don't think everybody can benefit from it, if it seems interesting, I'll talk about it anyway. Sorry for the lack of energy in my voice. The second Pfizer shot really kicked my ass. Alright, take it easy. Peace.